I'm Keith McCullough, and welcome back to day two. Thanks for joining us. If you're here with us yesterday, if you were not, we have everything posted on the replays. Today, I get an opportunity to have somebody on who I've not had on before, which is kind of hard to believe. But he's the perfect guy to have on right now, having been to his office as of late on the beach. It's one of the coolest offices, Meb, that I've ever seen. And it's very chill, and people need to chill the fuck out right now.
You're welcome back anytime, man. Listeners too.
It's really good to just get a pro who isn't on tilt, who isn't triggered, who isn't, polluting us with tweets on what the basis trade is today or whatever people need to talk about today. But what I found really poignant was this one quote that you had, and maybe we'll start with that because people do want to start with tariffs, so I'll give them that today. But you said tariffs may be the trigger, but overvaluation created the vulnerability. You have a much better look on valuation than most, so let's just maybe start with that.
You look back at the long history of stock markets. We're actually writing a coffee table book on the history of all the global stock markets, so going back to 1600s. But you can look at valuations in the U.S. really to the 1800s, and for many global countries, stock markets, for the past 50 years or so, and some even longer. But it gives you an idea of what history has been like, particularly in the US, and if you look at valuations is a pretty blunt tool. And we like to talk about the 10-year PE ratios, the Shiller-Cape ratios. It makes a lot of people's brains melt down if you talk about these, so I apologize. But we were the first to do this. A lot of people do this now, but we built out these CAPE ratios for every country in the world. And what you find is, it's pretty similar elsewhere too, where the long-term average for these markets is, let's call it 17 to 22. 22 means like you're in kind of that warm and a safe place when inflation is low and moderate and steady. But in the US, it's been as low as 5. And then my favorite bubble, 1999, got right up near 45. And, over time, it's been a pretty good gauge as to valuation. We track a bunch of them. We track dividends, cash flow, sales, all these, and they all tend to say the same thing, particularly at extremes. And, looking at this past end of year, you had a period where, on average, market cap weight for U.S. stocks was the second highest it's ever been after 99. It was up in the high 30s. I don't think it broke 40. Maybe it did. It was close. But on average, that's not a safe place to be. Other countries have been higher. So Brazil and India, China and India back in 2007, if you remember the BRICS, were at 50. Japan was the granddaddy, hit almost 100 in the 80s, and then went nowhere for 30 years. So on average, the market cap weight of U.S. stocks was expensive, which is another word for vulnerable.
Yeah, so when you take that encyclopedic knowledge of what's actually happened, and it's an empirical fact, so you just look back, and CAPE, by the way, is cyclically adjusting the earnings. So that's a big question I have versus 1999. If you think about it, well, first of all, assuming everyone knows it's causal, right, Meb? So if you get, because we're cyclically adjusting, when the cycle's accelerating, things tend to get multiple expansion, and when the cycle's decelerating, you get some multiple compression. I'm just talking very much, top down. Just stop me if you disagree with any of that. But this one in particular, pre-tariff, okay, was born also out of this thing called peak margin, like all-time peak corporate margin. Guys, if you show slide 57, we like to say like ever's a long time, right? But even if you go back and look at that peak, that cyclically adjusted peak, of PE in 1999, the margin wasn't even close to where it's coming off its all-time highs here. How do you react to something like that when you think about mean reversion, what the potential downside could be on margins?
When you look at a lot of indicators in the boom times, and let's be clear, this has been one of the best periods in history for U.S. stocks. So going back 2009, ignoring the last week or two, stock market has been a 10-bagger. If you were like in the queues, it's almost a 15 or 20-bagger. 15% a year for over a decade. That's only happened 4 times in history. The Roaring 20s, Nifty 50s, internet bubble, and today. So exceptional period for U.S. stocks. But usually when you get, at the end of these secular booms, all the indicators start to rhyme. So you had things like the highest percent ever of households allocating to stocks as a percentage of their net worth. The US is darn near over 2/3 of world market capitalization, on and on, and so it really doesn't matter. All the things kind of said the same thing. And the PE ratio on the Cape, if you go back 2009, it was like 12. So exactly as you mentioned, you had this massive multiple expansion. Now, a lot of it was justified in the US. You had great companies, accelerating growth, and many of these great fundamentals. But at some point it gets too expensive. And that's the Achilles heel of market cap investing is, it's only price. It's not fundamentally related. And so you have a lot of the companies that get very expensive end up being the biggest weights. And then you have everyone talking about the Mag 7. Now, the interesting part about this, and I think you and I talked about this at lunch, is for those that don't know me, half my brain is value, the other half is trend. And historically, if you look back at markets, and you can apply this to any market, the best kind of scenario is a cheap market that's going up. But the second best was an expensive market going up, which is where we had been, if you only look at those two indicators. The problem comes is when you go from expensive that's going up to expensive that's going down, which is where you certainly have been for the last month or so or two. That's a dark and scary place. But a lot of the fundamental kind of setups tend to rhyme when markets get really expensive.
Yeah,
and the same is true on the flip side too.
Yeah, I mean, that's what I was just going to get into. I mean, the process, no matter, where you are, if you're quantitatively oriented like Meb and I, and we have different components of our brains, obviously, but when he says, he's quant on the one side, value on the other side, what is trending bullish, what is trending bearish? I mean, that is just an empirical fact, right? Like, so when we start to think about it, I mean, that's why I developed the quads, Meb, which is essentially to say, an expensive market, guys, show the quads. I mean, if a market, if the economy of the market, Meb, is in quad 2, if growth and profits are accelerating alongside inflation in some cases, that's where you get multiple expansion. If you get into quad 4, which we currently are, where both growth and inflation are slowing and so are profits, and you're an expensive market, to your point, now you have the most bearish catalyst, which is an expensive market that is getting less expensive and the trend is down. So that actually applies. When I was looking at, again, your notes, I was like, I'll be damned, this guy, you called it the two, I'm only long 2 emerging markets at this point. And one is Colombia and one is Poland. Now, people have told me I need my head read on this, and in the last 2 weeks I've got my ass handed to me, so that's probably accurate. But on the way up, I mean, those were cheap markets that came from Quad 4, economic slowing. Poland's really easy to understand, very, very close to the Ukraine. And now they come out of a recession, so the economy comes out of Quad 3 and Quad 4. They start to accelerate, and you have an extremely cheap market. Now, EPOL, by the way, is the ETF for that. It's not your ETF. We'll get into your ETFs. But do you think that would you quibble with any of that? You'd argue with any of that, like in terms of how I hear I'm trying to interpret what you're saying into my process.
I'm going to tell you a quick fun story. Years ago, I was in Bogota, and I was giving a presentation to an institutional audience. And this was back when oil was, I don't know, 110 or something. And the Colombian stocks had just been ripping. And I said, look, don't shoot the messenger. This is a beautiful country, amazing food, great culture, beautiful people. Your stock market is the most expensive in the world. It was trading at back then a long-term PE ratio of around 40.
What year was it?
And I said, I can look it up. Let's call it maybe like a decade ago, 2014 or something.
Long time ago, yeah.
Long time ago. And I said, look, it's one of the most expensive in the world. That doesn't mean it has to go down. It could keep going up. It doesn't mean it has to crash. It could go sideways. But on average, like, that's a heavy weight. And when times change, often the catalyst is known with the fullness of history in hindsight. And sure enough, that market went down, I don't know, 70% or something. And now Colombia, we track across a lot of our major metrics, is arguably the cheapest country in the world. And it goes from beloved to hated, blood in the streets, massive drawdown. Now, I don't get back. I haven't gotten invited back. I want to. But historically, when you go talk to these countries or people, usually they'll be like, Meb, great. This is obvious, we know, but no one has any money left, right? Mm-hmm. Like the damage has been done. But in the breakout of that talk, I had pension fund manager after pension fund manager, Colombian, come up to me afterwards and say, Meb, you don't understand the local market. You know, the times are great. Money flows in every month from the pension funds. These stocks can't go down. It sounds like a 1929 sort of proclamation, and we've all heard this before. And then sure enough, you know, here we are. And so it feels, you know, certain things like similar to the U.S. stocks where people like they can't go down, they can't go down. Well, you know, certainly that's not the case of history at all.
No, it's what's amazing too is how closely they fit. I mean, the quads. Guys, go to slide 39. Who would have thought that I'm going to be doing Colombia? I mean, GXG is the ETF for that. But I do believe in this, right down to my bones. I built my whole business on it, that going anywhere with your hard-earned capital is a much better decision than being forced into what everybody else owns. In the Bag Sevens case, it's pretty obvious. But if you go back, like if you just go down the list there, Meb, for Colombia, the last of their quad four economically ended in the third quarter, where it's back-to-back quad fours. That's the worst you can have economically, was in Q3 of 2023. Now, that's basically the Colombian stock market bottomed in the first half of 2023, right? So markets start to discount the worst well ahead of time, then they bottom, then they accelerate, and Colombia went on a hell of a run economically with like 5 straight quad ones. Quad one is like nirvana, and that's what the return looks like in Colombia. So, why don't more people, there are way more people, let's just say, that would prefer to invest in with some bullshit narrative like that you're appeasing them because you're a nice guy. But I mean, you're like, more people would like to talk to you about what they think about Colombia than actually modeling it quantitatively. To me, they're just countries with tickers, and they're just rates of change of the economy. So why wouldn't more people think about it that way?
We like to say it's important for people to become asset class and investment agnostic. Now, that's the hardest thing in the world to do. I grew up mostly in Denver. I'm a Broncos fan. If you tried to convince me to cheer for the Raiders, I never could, right? I'd rather go to my death than cheer for the Raiders. But people, they get an emotional attachment to whatever they bought. And traditionally, that's been whatever has also worked well for them. So for the last 15 years, if you've been in U.S. stocks, that's the only thing you've known that is just crushed. This has arguably been the best period in history for U.S. stocks relative to a diversified allocation. The only comparable period would have been post-World War II, 1940s, in terms of years in a row of underperformance, because that's the worst. Your neighbors just every year in your ear about how they're outperforming and they're buying a bunch of crazy stuff. And also in terms of absolute magnitude of drawdowns. But, if you got any Canadian listeners, Aussies, you got some gold bugs out there, like you will not pry those gold bars from their dead hands, right? But the problem with that is we're emotionally attached. So my favorite check against this is to tell listeners, you don't believe me, go walk out in your garage or go walk into your closet and take a look around. And all that garbage, all those old clothes, all that old lawnmower, that aquarium, you have just sitting around, why in God's name would you not get rid of it? Same thing with portfolios. You buy something and become emotionally attached. And so there is a home country bias, but also there's a I chase performance bias. And that's true in institutions too. Institutions are just as bad, by the way, as individuals are, if not worse. Just they have more money and sound more sophisticated.
Well, isn't it the opportunity for the individual? I mean, you built your business on it. By the way, he's the founder of Cambria, which has got a bunch of ETFs. Some I want to talk about specifically. But how on the one hand could you be infatuated with, algos and AI, and on the other hand still be infatuated with the aquarium in your garage? I mean, it's like wake up. I mean, every other industry other than ours, people have moved to the edge of the information edge, as opposed to us, where we're people. I mean, we understand why institutions are paid to be dogmatic, because that's where their assets under management. That's how they get paid. You can't just like unwind even, God rest his soul, Jack Bogle's. You can't unwind their dogmas, their selling points, their marketing lines. I mean, that's not ever going to happen. But there is an opportunity for creative destruction. People like you and I to create ETFs and to say, hey, look, I don't know actually. Have you ever told anybody that they should buy every frickin' one of your ETFs under any circumstance?
No. We often tell people email me in and be like, somebody like, Meb, convince me to buy this over something else. And I'm like, first of all, that's totally fine. That fund or that strategy is totally okay, but it also depends on you. If you want to go do XYZ, God bless you. I think the biggest problem for most people is they don't have a plan. So they just come in and wing it.
Right.
And winging it is tough because, money is emotional. And, we love to do a quote of the investment quote of the day on Twitter. And we had one recently, and I don't know who to attribute this to, but it's, investing is the only area when things go on sale, everyone runs out of the store. And so you feel this emotion and panics, and that's been true as long as markets have been around, hundreds and hundreds of years. Our emotions work against us, and there's plenty of investing approaches that are just fine, but there's a whole slew, 10x of absolutely terrible, no good ideas and ways to go about investing. And unfortunately, so many people, particularly in bull markets, get seduced into that sort of gamification of gambling and eventually losing all their money, which hopefully is a learning lesson. Most of us have been through it. If you're old enough trader, you learn the humility and you have the scars. But unfortunately, a lot get taken out to the woodshed.
Well, how much? I don't know if this ChatGPT or otherwise can answer the question, but is there a percentage of people that invest that do not have an investment plan? They do not have portfolio construction rules?
My favorite thing on Twitter is to ask polls. So we always ask people, and it's usually like 80, 90% don't have a plan.
They don't have a plan. Yeah, because when I look at it'd be almost 100% of people that cancel Hedgeye, like in a fury, right? Like if something God, hell hath seen no fury really than me getting something wrong, which I get a lot of things wrong. So we get a lot of people who come on and people who cancel. But one of the biggest problems is portfolio construction. Like they have no portfolio construction rules. So it's like, oh, Keith and Meb just said they like Colombia and Poland. Actually, Keith did. Meb, I don't know. I think he did.
I don't like him. I love him.
There you go. Oh, so now I got two ideas. It's kind of like Old Wall 101. I read it in the journal. I saw it in Barron's. God help you if you're still watching CNBC. But I mean, it's like the game has changed so much, man. Like these aren't. I'm not here to give you picks. I'm here to give you a process, and a process starts with your plan. So when you tell people that. Like, how do you tell people that? Because I got to work on being more polite, because I just sound kind of like rude when I say it, I think.
The simplest analogy is say, look, think about your diet, and if you don't have a plan and you say, I'm just going to eat whatever, and midnight comes around and you want to go get some ice cream out of the fridge, like that's not going to work out. Like you have to have some sort of structure around what you're going to eat and how you're going to exercise. And it's even more important if you have someone to keep you honest. So whether that's your spouse, your children, your neighbor, a financial advisor, whatever, but someone, that can say, hey, let's put down that donut, or kind of shames you. Same thing. You're like, hey, I want to go trade all these options, weekly in my retirement account, on who knows what. You say, well, hold on, that wasn't part of kind of what your approach. But also it's important, like, not just for the bad times about having a plan. Like think about you have an amazing winter. So, think about you have an investment, a stock that's a 10x, a 100x, right? And it becomes a huge part of your portfolio. It's the same problem. Like every 10 bagger was once a double. Now, if you just say, well, my plan is to hold it and then it doubles and you like sell it because you're like, want to go to Cabo, it creates a similar problem. Like you've lost all those potential gains because you sold something way too soon that you would have kept. So I think diet's a good analogy for most people.
How do you guide them? So you got to have a plan, and how do you recommend asset allocation? How would somebody start with that?
We wrote a book on this topic. It's free to download. We're going to update it this year. It's called Global Asset Allocation. And we looked at like a dozen of the most famous asset allocation modules throughout history. Risk parity, 60-40, endowment style, every possible guru recommended portfolio. And they're all totally different. Some say you got to put a majority in stocks. Some say 25%, on and on. Hugely different portfolios. We modeled them all out for the last 50 years. And the crazy takeaway was that over time, so over, what is that, almost 50 years, the returns were actually quite similar. Now, the path was different, of course. Like what worked in the 70s, you had to have real asset exposure, gold, things like that. Value stocks did great. But in the 80s and 90s, equities did great, bonds did great, 2000s, different menu. And so on and on, they took a different path to get there, but they all worked. And my mom's from the South. We talk about this. The analogy we give is cooking. Like you make chocolate chip cookies, as long as you have some flour, some butter, some chocolate chip, the main ingredients, like the cookies are okay. She doesn't follow recipes. She tastes as she goes. Now, if you totally get rid of one category, it's not going to taste good, right? And so the analogy we give, the starting point we always tell people is the global market portfolio, which if you just buy every public asset in the world, that is what's called a global market portfolio. That's roughly half stocks and half bonds, and roughly, now it's more US now on the equity side, but for simplicity's sake, we say half stocks, half bonds, half US, half ex-US. No one in the US has anywhere near half their assets in ex-US, but that portfolio is a really hard portfolio to beat. In fact, it beats most institutions. But having those three components, global stocks, global fixed income, and global real assets, so things like commodities, commodity equities, tips, REITs, gold, those three buckets, I think, are the three requirements to have. And then you can kind of go sin a little and move away from that. But the exact percentages actually don't matter. It's just whether you have them at all. And most Americans is almost all, and this is actually true in most countries around the world, but all in on US stocks, all in on US bonds. They have almost no foreign equities, no anything else. It's just essentially just a US stock bet. And that home country bias historically has been an awful idea, not just here, but elsewhere around the world too.
Yeah, it's gold, just to name one thing. I mean, it's up 15% in the last 3 months. It's up another 2% or 3% actually today, I think. And why wouldn't that in certain economic scenarios be 10, 15, 25% of your portfolio? Well, it's because nobody really teaches that way. Nobody coaches it that way. So I'd be curious now that, and I haven't read that book. I'm gonna read it. But I mean, I'd be curious to see where, like, how I think about it, like how that fits relative to the field, because I really don't pay attention to. I'm very selfish and myopic and focused on my own process, but like I focus much more on what is the beta adjusted return of the asset class, sizing each asset allocation for that, that volatility adjusted or beta adjusted setup. And really, I call it go anywhere, because at any given time, I really don't give two shits about what my percentage is in any certain thing. I understand why the go anywhere that has everything outperforms, because by definition, it takes down the volatility adjusted component of the portfolio that'll take out the drawdowns. So, for me, I'm constantly trying to avoid the drawdown. Like, don't draw down, don't draw down. That's like rule number one. But guys, if you show I show my position maxes by asset class. So for example, I call gold, I call it a currency. So I could have a 12% position in gold. I can double down if I go paper gold and physical gold. Now I'm at 24. That's why I use the number 25. If you went to 25, you'd be a little bit more aggressive than me when I'm being most aggressive. But there are points in time when when growth and inflation are accelerating, that I'll be short gold. I'll have zero asset allocation to gold. So just to use that very basic example, where would that fit? Where one, you have defined risk-adjusted sizing, and two, you're 100% agnostic to the pie chart or any semblance of a color-coded asset allocation.
The time horizons at which a lot of these returns happen is way longer, I think, than most investors are willing to, kind of sit through. And if you look at the epics of history, and look at all these different asset classes, like we try to model this out as long as we can. And gold's funny because it's kind of like your crazy cousin who shows up at Thanksgiving or Christmas, where you're like, is he going to show up drunk and be an a-hole, or is he going to be like nice cousin and show up? Like, you just never know with gold, and it's great, and that's actually great as a diversifier to a traditional portfolio. But traditionally, it plays a very I think valid role in a portfolio, and certain times it's extremely valuable, but you never know. You never know who's going to show up when it comes to gold. But I think that applies to everything, you know, and I think your comments are thoughtful on the dynamic ranges. So many people, the challenge I think with many investors is they want to only think in binary terms, you know, and I have to be all in, 100% of my portfolio on something or all out. I mean, my crypto friends are like the most uh, the most perfect example of this. I asked Bill Sharp, you know, Nobel laureate, you know, inventor of the Sharp ratio. I said, "Hey man, we were talking about the global market portfolio," and I said, "Does crypto play a role in the global market portfolio?" And he was laughing and he said, "Yes, but not a positive one." But if you look at, you know, my answer to always to my crypto friends over the years, they would ask me to say, "How much should I put in crypto?" And I said, "Well, this is going to satisfy no one. You're going to hate my answer, no matter what, because you either want to say 100% of my assets should be in Bitcoin, or Charlie Munger, zero crypto crapo. It's terrible." And I said the answer is probably 0.5%, 1%,
Yeah.
because that reflects the global market portfolio. Now you want to move from there, great, but as far as like where it fits in the history of sort of assets, that's kind of a good starting point. Now that again satisfies no one. No one wants to hear that.
Well, I know what the answer is on why people, you know, why what I do is not conventional, and it's called timing and it's called turnover. You know, those two words are almost the antichrist of, well, they are the antichrist of a Bogle, you know, enthusiast or evangelist. For
I got to add something here though, Keith. This is a gem because the Bogleheads, I'm like their number one enemy, and I don't know why because like they should love me technically. Like we launched the first asset allocation ETF. We didn't charge a fee on it. First one that didn't have a fee. Now it owns underlying ETFs, so it has a small fee. So a lot of stuff we do is very Vanguard-esque. But there's a lot of things about Vanguard I think that people don't know. One, they have more active funds than passive funds. So they're one of the largest active funds in the world. And that triggers any of the Bogleheads if you tell them that. They usually don't know that. But second, there's a video, and I can send it to you, and I love it. And I think, you know, a Bogle, you know, should be on the Mount Rushmore of, you know, things that have helped investors. But he has a video in the late night talking about the late 90s and talking about timing. And he said, look, in the late 90s, it was very clear stocks were in a bubble, they were expensive. He's got an amazing article from the 90s called something like Occam's Razor, and it's a very simple formula to predict forecast stock returns for 10 years. You know, it's starting dividend yield, earnings growth plus change in valuation. Now, he wouldn't say use it to predict or time, but he would say, you know, maybe for expectations. By the way, Vanguard says US stocks do about 4% for the next decade. But Bogle, in this video, he talks about how he shifted his portfolio in the late 90s. And this is market timing. He says, you know, let's say you're 60-40, maybe you move to something like 40-60. And he's like, and I sold US stocks. Now he said, now you should never go from 60-40 to 0-100. You know, that's kind of his MO. But he absolutely was talking about market timing and how much it made sense. And it's a gem of a video. It's a thoughtful video. So that this, you know, I love telling my Boglehead friends this because they lose their mind about it. But it's on there on the internet, and you can we'll send it over to you.
Well, you know, people generally don't read books, right? But if you read the history of Bogle, I mean, he started, you know, at Wellington. He was an active manager. I mean, the reason why he believed a lot of what he believed is because he and his new partners, who he shouldn't have had, blew up. I mean, it's not like he didn't learn the lessons. But my general premise here is, okay, look, okay, you got, what did he invent? You know, low fees, right? He marketed the shit out of that. That is phenomenal, right? Low fees. What he didn't market, because he couldn't market, and you can't market if you're a bag holder, is no drawdowns. Yeah. There is nothing in the history of passive investing that is protected against drawdowns and crashes on orders of magnitude that we just saw in the last two to 3 months, for that matter. So what do you think about that? I mean, I think that for people like you and I, that's a massive opportunity. If you start with risk management, I mean, whether your lens is value, whether it's trend, whether it's, you know, quantitative trend, et cetera, et cetera. I mean, you know, it's a new dawn, I think.
This is the Achilles heel of index market cap weighting. And so you hit a funny bone real quick here, where if you go back to 1970s Bogle, indexing meant one thing and one thing only, and that was market cap weighted. Okay. Yep. Now, if you go talk to the average investor and even the average advisor, and you say, explain to me what market cap weighting is, they say, well, we invest in the biggest companies in the stock market. And you say, sure, correct. Biggest by what measure? and they'll say, oh, earnings, revenue, like they got, the biggest companies, most people. And no, none of those things. Market cap weighting is price of the stock times shares outstanding. That's it. There is no tether to fundamentals whatsoever. And the Achilles heel of market cap weighting is the boom bubble period. So when stocks go up way too much, you put most of the money in the things that have gone up the most. So US 99, you put most of your money in the stock market, in the market cap weight, when it was at its peak most expensive, is when you put the most in. Ditto, think about Japan in the 80s. Japan in the 80s was the biggest stock market in the world at a PE ratio of almost 100. So if you're a diehard Bogle Vanguard indexer, you put most of your money in the most expensive stock market in history at the exact worst time. So then you end up having these long and painful drawdowns. Japan lasted 30 years. The US has gone decades with no return. Most global stock markets can, if you look at China last fall, China had gone nowhere for its entirety of like 30 years, right? So you can have these periods where stock market have no returns. Often, when they're really expensive is a terrible starting point. And so if you have no risk management, the problem with buy and hold investing, and we manage buy and hold ETF, okay? So don't get me wrong, is that you just have to sit there, right? And those drawdowns, if you look at 60/40 portfolios around the world, you can't really find one, particularly on an after inflation basis, that hasn't declined by 2/3. And let that sink in, listeners. 2/3, not 1/3, 2/3, right, is your drawdown potential. And that's really hard for most people. We say the Richter scale, drawdowns are like a Richter scale. So earthquakes. I'm in LA, so this is a relative example. Most people don't really care. You're down 10%, no big deal. 20 is where the inflection happens, and it's like an exponential logarithmic scale every 10% down. So, you lose 30, 40, 50, you go crazy worse every 10%. And that's the mathematics. You lose 50, you got to get 100%, get back even. You lose 75, you got to get 300%. It's a huge hole. So trying to avoid those drawdowns is like the number one thing to do in investing. Historically, what can you do to avoid those? There's a number of things. Trend following historically has worked great. It doesn't work on short-term periods traditionally, but over long bear markets, it works great. Diversification also usually, and then usually just not paying 200 times revenue for securities at their peak is another one as well. So there's a number of things you can do, but I 100% agree with you. The drawdowns for buy and hold. How many investors do you know in 2009 said, I couldn't take anymore, I sold everything? Like I had people tell me that in 2012, 2014, 2016. We have over 100,000 investors. And people would be like, look, I sold everything. I couldn't take it.
Yeah.
I'm finally ready to get back in after hundreds of percentage points of return later, and that's unfortunate, right? Because they couldn't sit through the drawdowns.
Well, that's why, as opposed to just focusing on low fees, you have no fees, to your point, on some products. I'm introducing my ETFs are going to have very low fees. That's no longer innovation, okay? Ripping people off is is no longer their edge. But starting with drawdowns instead of just standing there, like starting with drawdown risk, the reason for that's very simple. Never mind losing 50%, you're done. You go from down 20, you got to make 25. You lose 30, you got to make 43% back to get back to break even. That's why those step downs are nauseating between like every 10 points, right? Because you're not coming back from down 30. And yeah. That's why when you look at like Ethereum, for example, Ethereum's has lost 2/3 of its value in 3 months. Okay? So if you're one of these captain, innovator guys, and you're really cool with your crypto ideas, and your pie chart is 50% crypto, and that's like one of the major asset allocations, you're done. You're not coming back from that. That's why people give up. So to me, I bet you if I took, so let's just go back to it and say, okay, if I took, because I'm looking at some of your ETFs in particular that have gone vertical lately, like in certain environments, those suck, and in other environments, they're awesome. Because that's what diversification is, right?
When you have coming up on 20 funds, we're launching one tomorrow, and so the market volatility, it's not stopping us from jumping in the pool. Something is always doing terrible, Yeah. And I think you and I talked about this at lunch, and I think the vast majority of the industry likes to shy away from talking about they're losers. You go on Twitter, everyone's only a winner, right? And we love like talking about our losers, and we've done a few emails over the years where we had one called "Totally Not Crushing It." Everyone's always like, "I'm crushing it, I'm making so much money." I said, I want to profile what's not working, and so we profiled one of our ETFs. It's called VAMO, and this fund, you'll understand why it wasn't working at the time. It buys 100 stocks with great value and trend characteristics. So think cheap stocks that are going up.
Yep.
And historically, that's largely, hasn't done a great job. Versus S&P's mowed down everything. So just relative to the S&P. But it would hedge that portfolio anywhere from 0 to 25, 50, 75, 100% with S&P futures. So for the majority of the cycle, it had everything going against it. It was, smaller cap than large cap. It hedged. So half of the hedge is value, half is trend. So it was hedged for a large percentage of the time. And then, currently is 100% hedged. But we wrote an email saying, look, this fund has sucked, but do we think it's broken, or do we just think that it's been, part of the market regime and part of the style has been out of favor, and, when markets turn, it'll have its day in the sun. And we said, look, we believe in it. I put all my public assets into our fund. So,
Yep.
we believe in it. And like to the day that fund turned around and started outperforming. And, I think the market gods reward humility. I think that the number one characteristic I would want is someone who's been through it, has the scars. And so we're always telling investors will call me up and say, Meb, I bought your fund 6 months ago. Doesn't matter which fund. I'm losing money. It sucks. I'm down 20%, whatever I am. And I'm like, oh, it can get way worse than that. So let's be clear. Like, if you buy an active strategy, this thing could underperform years in a row. It could draw down probably double that. And they're usually surprised by that statement. They're used to hearing someone say, oh, no, blame the tariffs, blame whatever, blame China. It's their fault. This fund, it's, da da da. Well, that's not the case historically. We all have our losers.
We all do, obviously, and unfortunately, fortunately for us, not a lot of people are paid to learn from those mistakes because they keep selling the same product. Again, that's their business. They're going to market it to the death, and now Bogle is gone. So, it is what it is. You and I will be too. But if I were to sell your portfolio, like if I was one of your, I don't even know if, do you even have a sales team? Because I'm signing.
We got a few now.
Okay.
Yeah, we historically didn't, but now we got a couple running around.
So if I can be your sales guy right now, what I would say is as soon as we go into what you defined as, okay, now you have an expensive market that's breaking down, well, I'd say, okay, if I tell you that that's what's going on, you should go from 80% long what's working to long a portfolio of his TAIL. I'll just use the tickers, but TAIL is one that's gone vertical for you, or TYLD, or GVAL, or VAMO. So now if I take 20% of my capital and split it 5% across each of those four, I just have like half the aneurysm that most people are having this morning, right? Because I took the risk off signal as indication or as signal itself to just change what components of Meb's options that I can pick, just like you would pick anything else. Like you use the garage in your closet. When it's raining out, do you choose a different option when you look in your closet? Of course you do. But in investing, people don't do it because they don't have any options.
It never rains in Los Angeles, so that's a tough analogy. People, it's like it may as well snow 10 feet. People go crazy. They stay at home. They don't drive. It's the weirdest thing. Thinking about, by the way, GVAL is our fund. It owns both Colombia and Poland.
Yes.
We actually had an email queued up, and I didn't think it was appropriate to send it this week because markets started going kind of nutty. But there's a great, if you guys remember, Peter Bernstein was a great writer, and he talked about asset allocation a lot. He wrote a book about gold. He wrote a book about risk. All these great old, and I want to make sure I get this quote right. So he had a quote where he said, "I view diversification not only as a survival strategy, but also as an aggressive strategy because the next windfall might come from a surprising place." And so we had an email queued up talking about Q1 because in Q1, you had a massive dislocation where foreign stocks, and this has continued, but it's just, the spread has moved up and down with everything going up and down, where a basket of the cheapest countries, including Colombia, including Poland, outperformed the S&P by 20 percentage points.
Huge.
Now, U.S. has creamed foreign for as long as we can remember. So this GVAL fund was the second in our series of totally not crushing it. But I think to the day of writing about it, that kind of has shifted. We'll see if that continues. But it was one of the biggest dislocations we've ever seen between U.S. and foreign. And historically, U.S. and foreign is a coin flip. If you go back, Bridgewater's got a great piece that looks at stock returns by decade. And I think it's of the last 12 decades, the U.S. has only outperformed a global equal weight, and most people think of the number in their head. It's only like 4 of 12, and if you look back on history, like people just extrapolate the most recent past. But 2000 decade, the U.S. was one of the worst asset classes, market cap weighted. Anyway, so we had an email queued up talking about this exact topic, but didn't feel it was trying to read the room a little bit.
Well, I mean, if you're a global macro manager, and this is like, again, I think I don't see this as a Schadenfreude moment for the hedge fund industry, but I look at more as an opportunity for people like you and I. I mean, when you talk about a 20% relative return, we're not 200 basis points would be fine if you're running a long short fund. If you're running 200 basis points over, that means you're doing 2% better than your bench. In this case, 2,000 basis points better by being long global value in a period where most people are bag holding bag 7, which is the opposite of that, right? So,
well,
and the number one thing people are going to say back to guys like you and I is like, yeah, I hear you, but you couldn't have timed it. Well, we did. So I don't know what you're talking about because that's not in my account. Your problems are not in my account. The opportunity are in the other people's accounts. And that's where I'm looking at like some of the things that you've built here and say, wow, this isn't Vanguard.
I mean, we try to only launch funds that don't exist. So the vast majority of our friends in the ETF world, I love them to death, but they throw as much against the wall and sees what sticks. Like they're launching products, and if they find a home, great. If no one wants them, it's like a call option, right? And we only launch funds that I want to put my own money into. And so often they look extremely concentrated, weird, or different.
Yeah.
And so in many cases, like the GVAL fund, most of those countries are trading at single-digit PE ratios. And relative to the S&P, this is the first time, by the way, that we do a quarterly valuation update to a email list we send out called the Idea Farm, and we rank all 45 investable countries by a bunch of valuation metrics. And this was actually the first time that the U.S. was the most expensive country in the world. It's always kind of floated around the top. India and Denmark were in there, but both of those had sold off. But a lot of the cheap countries are screaming cheap relative to U.S. market cap weight.
That's a great point to end on. I can go on and on with you about this, but appreciate it. It's good to have met you recently. Appreciate you making some time here.
Anytime you guys want to come, if markets are stressing you out, come visit us in Manhattan Beach. We'll go for a surf, get some tacos, have a beer, relax a little bit.
That's pretty much what I did with him. So he's a truth teller. Thanks, man. Appreciate it.
All right.
And what a great guy to come in and level and de-stress you, right? I mean, too many people are stressed because A, they either don't know what they're doing. Watch anybody in any profession that gets stressed out. It's because they really don't know what they're doing. B, they don't have a plan. C, they don't have portfolio construction. Or A, B, and C altogether, which would be worse. So, again, you can get to a better place. There are plenty of people and tools like just listen to Meb. I mean, just listen to that 45 minutes of education, and I'll thank him again for that. And on to the next, where we're going to be getting a little deeper into commodities with my friend Josh Crum and David Greeley.